Cash is king in retirement, especially in the environment we're in right now. Cash is king. But when you have that cash, you have to take that cash and invest it. You can't just have the cash sitting around, especially with high inflation. You do that and your money is just going downhill. So you need to take that cash, sure, leave some on the side for day-to-day expenses. You know, leave maybe a year. Take the rest of that, another couple years, put it into I-bonds, T-bills. Cash is king in this environment. Now, here are pros and cons for that thought though. Number one, the pros for cash are the sequence of returns risk, which I've just got hammered on this year. I mean, I got plastered by sequence of returns risk. What that is, for those of you who don't know, is in the first couple years of retirement, if the market is doing bad, it's really bad for your retirement. And these first year and a half of my retirement, the market, as everyone knows, has just gone boom. If I would have known that before I retired, I wouldn't have retired, basically. So yeah, sequence of returns risk, it's great to have cash on hand, because what makes it even worse is if you dip into those investments while there's a bad market, you're just compounding your losses. That's just the most ridiculous thing to do in the world. So having cash on hand during this kind of environment with sequence of returns is great. Number two, if you're in high interest rates, okay, it's good to take that cash and put it into T-bills, I-bonds, money markets, CDs, so you can make some money off that cash. So it's just not sitting there doing nothing and you're losing your money on it. So take that cash, like I said in the beginning, set some aside for your day-to-day expenses, maybe a year, take another couple years, put them into those investments I just talked about. You can get a great rate of return nowadays with the interest rates we're in. Another pro to having cash on hand, and a lot of people follow this, I'm not a big proponent myself, the bucket strategy. What that is you'll take, say, 3 years, some people take 4 years of cash. That's their first bucket. That is the money they're going to use in this bad environment. The second bucket, this will be years, say years 5 through 9, let's say. What they do with that is they'll take low risk investments, so a lot of bonds, a lot of stocks as well, but balanced out, you know, so you're maybe 60-40, maybe 50-50 stocks and bonds. That is what they're going to use for those 4 years. The years after that, say years 9 through the rest of your retirement, these people have it in bucket 3, which they have heavily invested in stocks. Because over the long run, stocks are going to beat anything out there, right? We've talked about it before, around a 10% return if you go out a long time, 1 decade, 2 decades. So that is the bucket strategy. Myself, I don't really believe in that. I just believe in having what I currently have is about somewhere in between, well, probably about 2.5 years of cash on hand, but the majority of that is invested in T-bills and I-bonds, okay? The rest of my portfolio is just 60-40 stocks to bonds, which I'm comfortable with. And if I don't have to dig into that, if I can live off my cash, and in this case, I'm getting some money from YouTube, and I'll be golden. Last year, I took out a little over 4%, 4.2%. And for those of you who know the 4% rule, if you can take out 4% of your money and not go over that, or in the case of the 4% rule, they adjust it by inflation every year. So let's say you took out $40,000 the first year, you adjust that by what the inflation was for the second year. So if I can stay right around 4%, and this year it's looking like I can come in under that with my YouTube income. If I can live off cash and YouTube and take a little bit, let's say 1 or 2% out of my investments, 401ks, I'll be looking good. Okay, so those are the pros. The cons of holding cash. This is a big one. Depends on the kind of person you are. A lot of people, if they have a lot of cash that's just sitting over there waiting for someone to do something, they'll take it and spend it. Hey, let's go to France this year. Let's spend $5,000 on a vacation. Okay, maybe once, but don't don't take that trip to France and times it by 3, you know? Or hey, look at that shiny new car, man. We got to get one. We haven't got a nice new car in 5 years. Let's get one. If you're that type of person, it can be hard sitting on a buttload of cash because there's temptations. There's a lot of temptations that come along with that. All right? Second one, if you have too much cash on hand, you're not going to get any return on your investments. So that's why for me, I'm comfortable with right around that 2.5, I don't know, about 3 years of cash. And again, a lot of that's invested in T-bills and I-bonds. I wouldn't go past 2.5 myself because you've got to have, even in a down market, you've got to have your investments working for you. And that means being in the stock market. You don't have to be heavy in stocks. Like I said, I'm 60-40, but you have to have the bulk of your investments because it's not like you retire and you reach the finish line. No, 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 no. That money's got to work for you in retirement. So the majority of my investments are still in the stock market. Yeah, it can be painful to look at it from time to time, right? That's why I try and limit that. But you need to have that. So a con of having too much cash on hand, like some of these people in the bucket strategies will go out 4 years, some even 5 years of cash on hand. That's taken too much out of your investments. Your money is not going to be able to work for you in the long run. Got to have that working for you. Or else, what are you going to do? You're going to 20 years from now, you could run out of money. You could have all your money in a mattress. Okay, hey, here's a mattress. Oh my God, 10 years later, whoa, this feels a little thin now, doesn't it? 20 years later, hey, wait a sec, there's one $20 bill left. You got to have the bulk of your investments still in the stock market. The last con of holding a lot of cash is inflation. Now, we're in a high inflation period, as you all know right now. That's why I advise again, T-bills, I-bonds, CDs, money markets. In a high inflation period, you cannot just take a pile of cash and sit on it, unless you have a couple $1,000,000, which I definitely don't have. For those of you who are seeing me for the first time, my name is Duane. I retired on just over $500,000, a little over a year and a half ago. If you're interested in learning the tricks and what not to do and what to do when you have a moderate amount of income to last you 30 years, think about subscribing. And if you like the video, please like as well. So yeah, that last one, inflation, especially right now, it's a killer, isn't it? It's a killer. So, take those pros and cons. I mean, depending on the kind of person you are, if you're disciplined, it might be fine for you to hold on to 3 years of cash and you won't touch it except for putting it, to work for you and like those things we talked about. But anyway, those are the pros and cons. Which kind of investor are you? Whatever it is, you better still have some of that, a large part of your portfolio in the stock market. But in times like this, it is very good to have cash on hand in retirement. And just remember, guys, we got this.